Hello, everyone. Hi, Fems. Hi, Vote. Hi, Bobo Hero. Hi, Isrik. How you all doing?
Doing fine.
Fine, sir. Good evening, sir.
Cool. Awesome. I hope you are having a good weekend so far, right?
Yes, sir.
Yeah.
Awesome.
Yeah.
So, for some of you that didn't tune in for yesterday's session, I don't know if you have any questions related to that session yesterday, or was everything well understood? Hi, guys there. Did you understand the session very clearly?
Yeah. It was clear.
All right. Perfect. So today we're going to cover inefficiencies, how we use inefficiencies in the market, both as points of interest where we take our trades, and also using it as a drawn liquidity that attracts price, whether it's to the upside or to the downside. And we'll also use inefficiencies as take profit positions. Now, inefficiencies are also known as fair value gaps, imbalances, but overall, they're just inefficiencies. So no matter what any educator calls it, it's all an inefficiency. Now, what specifically is this inefficiency? Now, for some of you that don't know what is an inefficiency, it's pretty much those gaps you can see right here. You can see this previous candle here, the wick stopped here, then there's a gap behind, gap in front, and then the wick stopped here. So this entire zone is an inefficiency. It's also a fair value gap right here. An inefficiency, it's a fair value gap. And you can see at that in this location, this inefficiency acted as a draw on liquidity and it attracted price to the downside right here. So if you are on sales, you would have used this inefficiency as your take profit position. And if you are looking for a buy, you would have used this inefficiency as your entry position where you start looking for entries for buy opportunities. The same thing goes to this position here. This is also an inefficiency. The wick stopped here and there's a gap behind. The wick stopped here as well. There's a gap in front, leaving another inefficiency here. You can basically use that as a point of interest, both as a drawn liquidity for price to attract it and go to the downside. So you can be looking for sales from here, use this as your take profit position. And you can see right here this inefficiency, even though it didn't work for buys right here, the market came back into that position to use it as support for buys for continuation. Also, putting this into perspective, this is also an inefficiency. Now, this one right here, because it's already been invalidated right here and it wasn't used for buys, it becomes an inverse fair value gap right here. And price can also use it. So now, me personally, I don't really use an inverse fair value gap on its own individually. I like to see other confluences aligned with it before I use it as a point of interest. So example, now an example is I can see there's an inverse fair value gap here, which is an inefficiency that got invalidated that wasn't used for a buy. And I can see right here, there's an inefficiency here. Now, if price comes into this position, to me, it's a high probability area for buys. The reason is because there's an inefficiency here, and then there's this inverse fair value gap behind. So that is multiple confirmations that price will probably come down into this position and use it as support for a continuation to the upside. Is that making sense? Now, for some
Sir.
of you, for some of you that might still be struggling with understanding that inefficiency, there's an indicator that you can use. I'm just going to give you guys the tools, even if you're struggling, you're a newbie. You can literally just go to TradingView, type indicators, and search fair value gap. You can see the first one here, locks out, go click on it. And it's not perfect, but it does the job. And you can see how it's outlined some of the inefficiencies. It's outlined this one here, but it didn't outline the one here. And then it outlined this one here, and then it skipped this one. So just bear that in mind. It's not perfect, but it can help you. For some of you that are beginners, it will help you to know what it looks like. So you can now individually mark them out yourself. If you can't see it, you can now use this as support to mark them out yourself. But I highly would recommend for you not to depend solely on indicators. I'll give you all the indicators that are going to help you, including for market structure as well. I talked about market structure yesterday. Now, if you're struggling with understanding market structure, there's also an indicator that can help you. It's not perfect, but this can actually help you with understanding market structure on the lower time frame. So this is weekly time frame. And you can see that this indicator right here has already outlined the higher high, the higher low, higher high, higher low, and then here, potential higher high. I wouldn't really call this a higher high because there isn't any candle closure yet. So, but the indicator doesn't know that because it's just an indicator. That's why you still need to understand these things without using indicators. So always remember, indicators are only there to just support you. Don't just use indicators and think it's some sort of holy grail that will help you be a profitable trader. The only person that can make you a profitable trader is yourself and your skill sets. The indicator is just to support you with what you already know. So just bear that in mind. And for some of you that are struggling with market structure on the lower time frame, you can also use this. After you've marked out the market structure on the lower time frame, if you're still unsure, you can just use this right here, turn it on, and then you can see it can be a little bit weird sometimes if the market structure is weird. So I'll just take this back to this position right here. So right here, you can basically see how the indicator can literally show you that the market was trending to the downside, creating lower high. This is a lower low, and then created a lower low, and this is a lower high. And yeah, to still show you that an indicator is not perfect. It's actually confused about this. So it just named it a higher low. Why? Because it didn't create a new lower low. So it just tagged it a higher low. And it's not wrong. But some traders can actually get confused by this and then make wrong decisions. And then here it's showing you this is a lower low and this is a lower high. And that means breaking above here, that's a break of structure. Right there is a break of structure. So that's already showing you that the structure has shifted from bearish to bullish. And you can still do the same thing on the lower time frame, even on the 1 hour time frame. You can see the indicator is not perfect. Just bear that in mind. You can see here, it's naming this a higher high, but I wouldn't really call this a higher high because it created a new low. And then this is the higher high. So it's not perfect, but it can help you. So if you want to use that indicator for market structure, you can also put it in here. It will just help you to make things a lot easier. So here, happy September, that's the one you put in your chart and you can use it. So I mostly use it on the lower time frame and I don't use it on its own. So what I do, for example, if I'm looking for a trade, I'll just show you a quick example, then we'll continue with the session. I know some of you just want the easy way out. So I'll just give you all the easy things that will help you. So this was one trade that I took last week. I'll just show you an example with that. Let me see. Oh yeah. So here's the trade. It had multiple entries and those entries were from the 5 minutes time frame. So I'll just take this back to that price action. Now, if you take it back to that price action, you can see this is the area. And this is my break of structure. This is my lower high, my lower low, my break of structure. So I'm using the high as my entry, my second entry, my first entry. This is the lower high, my lower low. This is the break of structure. This is my first entry. Now, if you turn on the indicator, and the indicator, bear in mind, the indicator is only focused on the current price action. So if you want to see what is, or if you're back testing, you're going to have to take it back to that price action you wanted to show you. But if you're trading live, if it's a live analysis, you're literally trading live, you'll see it's a lot cleaner. Now, you can see in this case, it's literally labeling this as higher high and this as lower low. It's right with this one, but it's wrong with this one. And why it's wrong here is because of this choppy price action. So just bear that in mind. But the good thing is it's outlining that this is a high and also this is a low. Now, let's see if this one is better. So when it's a choppy price action, the indicator gets confused. And just so you know, the indicator doesn't belong to me. Now, in this one, this is the lower high and this is the lower low. So this one is a lot perfect. And the reason why this is perfect is because the price action is well simplified. And you can see here, the indicator also labeled this as higher high, which is actually wrong. This is the lower high that created this lower low, and then this lower high created this lower low. And the reason the indicator thinks this is the higher high is because it rallied above this lower high. So it now believes this is a new higher high. So that's why you need to still understand these things on your own, and you're only using the indicator as an added confluence. When you've outlined the lower high and the lower low, you just use the indicator to confirm that that is the actual lower high and the lower low, and you're waiting for the right key level to get broken. Does that make sense, guys?
Yeah.
Yes, sir.
Awesome. So let's just go back to our analysis on inefficiencies. Yes, so basically, the three most important things you need to understand in trading. One is market structure. And the second one is inefficiencies, also known as fair value gaps and imbalances. So they're all the same. And then the last but not the least is Fibonacci. So tomorrow we're going to cover Fibonacci, how you can use Fibonacci from the higher time frame to the lower time frame for entries. But today our focus is just going to be on how to align market structure with inefficiency or fair value gap and imbalance. Now that you can see that the market structure in this case is bullish, all you're looking for is those inefficient price actions that price will come back to retest, and then you can use it as a point of interest to take your trade. And you can also look for another inefficiency to use as your take profit. Does that make sense? You're using the inefficiency, point of interest to take a trade, using the same another inefficiency as an area of interest for take profit. Now, if you're on a trade and you can see there's a higher time frame fair value gap, the best thing you can do is to mark that zone, even if your take profit is still way above that area. Let's say your take profit is a daily inefficiency, and then on the 1 hour or 4 hour, you can see an inefficiency before that's your daily inefficiency. The best thing you can do is to mark out that lower level inefficiency, mark that zone, use it as a take profit position. When price comes to that position, you can scale out some profit, because sometimes I've seen price mitigate 1 hour, even 15, even 5 minutes inefficiency and reverse from there and run your stop. So bear that in mind. So in this case, you can see this here is our point of interest. And when we scale down to the monthly, you can see how price came down into that position. And you can see how that same inefficiency from the 12-month time frame aligns with a weekly high. This is weekly lower high, weekly lower low. And then this is a break of structure. Now, let me take this price action back. Now, if I take this price action back to this position and use that market structure indicator, just to make it easy for you guys, you can basically see that even the indicator is a little bit slightly confused. So let me just take it back a little bit more. So I'm going to take it back a little bit more. So the indicator is much more focused on current price action. So I'm trying to see if it's going to tag this high, but it's failing to tag this high. So it's only tagging this high and it's not tagging this high. But this is the lower high and this is the lower low, and this is the high you want to see broken. So right there, let's take the indicator off. So right here, this is your lower high and this is your lower low. And you can see This was a clean break of structure. This was a clean retest. And that retest area, that was the monthly previous high that got broken and retested on, also aligns with the 12 months inefficiency. This is to show you that the market structure aligns with inefficiency. And the only thing you use the Fibonacci to now do is to know which zone we are in. Are we in discount, premium, extreme discount, extreme premium? That is all you're using the Fibonacci to do. Now you can see that already we've come down there, we've mitigated that zone. What did we do? We rallied to the upside. The market left another inefficiency here. What do? You use that inefficiency as your point of interest. And right here, look at what happened here. There's another inefficiency up here. So after price came down into this 12-month inefficiency, it rallied up to a monthly inefficiency, used it as resistance to come down into another monthly inefficiency, used it as support to rally to the upside to go into another monthly inefficiency. So this is you literally, the moment you understand the market structure and how you can align that market structure with the inefficiency, the trading just becomes a lot simpler. Now, I'm not going to say it's going to be easy. I'm never going to use the word easy because even ABC is not easy for kids until after they learn it. Now they're like, oh yeah, ABC is easy. It's still the same with trading. It's going to be difficult until you figure out a systematic approach. And the systematic approach is what I'm teaching you right here. This is literally the simplest model you can use and trade. Understand the market structure, mark out the inefficiencies, wait for price to mitigate them, wait for your time frame break of structure, take your trade, target another inefficiency. It is literally that simplified. Right there, the moment we mitigated 12-month inefficiency, we went straight to a monthly inefficiency. After that, we went straight down to another monthly inefficiency. You look for a buy. Price coming here, you look for a sell. Price coming here, you look for a buy. Price coming here, you look for a short-term sell. Now, I didn't say long-term sell. You look for a short-term sell. And you can also use this as a buy, use this as take profits. Price coming into this position, you're looking for, you're closing the position, you're taking profits. You're buying under here, you're closing here. And then you can still do the same exact thing on the lower time frames. And you can see on the lower time frames on the weekly, what do we have right here? You can see right here, we came down, mitigated an inefficiency and used it as support. What do? You wait for your time frame break of structure and you target another inefficiency to the upside. You can look for any inefficiency. It could be an inefficiency from the daily, 4-hour, 1-hour, monthly. It's entirely up to you to figure out which inefficiency is going to be the next draw on liquidity. Example, this is an inefficiency. You could have bought down here. This is take profit. Or you can literally buy down here. And this is also can be your take profit position right here. You can use this inefficiency as your take profit. You could literally buy from here, target here as take profit. Is it making sense, guys?
Yeah. So, on all the areas where, like, when we are moving up as bullish, the
Yeah.
inefficiency acts as a support to the upside. Then when we meet it within our way of going up, that's where it may do a retracement. So that's where we take our take profit and we think of taking another entry, right?
Exactly. So now this is a very good example. Now you can see that you got in from down here, this inefficiency down here on the weekly, and you're targeting an inefficiency. Let's say you're targeting an inefficiency here. Let's say this is an example. You're targeting here as your exit. You got in from this inefficiency here. This is your take profit. The market hit that level, closed that position, rallied, came down into this inefficiency. You look for another buy opportunity. And while you're buying here, you're targeting this next inefficiency here. The market hit that level. And after that, it rallied, blast through, came down again. You're using this inefficiency here again as a buy zone. And after that, you get into a buy here and you're targeting the next inefficiency, which is this one right here. And the market hit that level. The moment it hit this level, you take profit. It came down again into another inefficiency down here, and you look for another buy opportunity. And once you're buying from down here, you can see how we consolidated, took liquidity, but we eventually rally straight to the upside to mitigate the next inefficiency resting right here is our next drawn liquidity. So everything we're doing here, we're still targeting for price to go into this inefficiency. And after this inefficiency, the market will probably leave, and it is a lower time frame, maybe a daily 4-hour inefficiency that you can still use as support again to buy it again, and you can still be targeting another higher level inefficiency. You can go to like monthly to look for the next drawn liquidity, the next inefficiency. Potentially right here we'll have this inefficiency here. Is that making sense?
Yeah, it's clear.
So for tomorrow's session, we'll go in depth on what time frame breaks of structure you're going to use and how you combine it with the Fibonacci so you can get precise entries. So that way, even if the market is crashing, everyone is screaming, you basically know what to do. You know which area to get in, and you're trading with confidence. And you're not trading with lots of confusion, not knowing which area you want to get in or whether the market is going to keep going up or down. So let's have a look at the lower time frame on the daily, see how that works out as well. Now on the daily, down here, you can see price came down and mitigated the inefficiency resting down here. But firstly, we broke structure. We're trending to the downside, creating lower high, lower low, lower high, lower low. We broke structure here. And after that, we came down into this inefficiency down here. And after we mitigated it, we used it as support. The market rallied. And you can use here as your take profit. You can see that right there. I'll make this a different color now. You can use that as take profit. You're buying under here. You're taking profit right there. And after you take profit, price came down into this inefficiency here. Use that as an entry, and then a rally. Came down again into this inefficiency. Use that as an entry, a rally again. Now, for some of you that want to be day traders, I'll show you how you can also use this on day trading as well, because it doesn't really have to be, you all don't have to be swing traders or long-term traders. You can also day trade with this same concept. Now, if you want to day trade with this same concept, the first thing you need to know is what is your drawn liquidity? What do I mean by drawn liquidity? What is attracting price to the upside? Once you figure out your market structure, what is the next drawn liquidity? Which area will attract price to the upside or to the downside? You figure that out already. In this example, you can see that the drawn liquidity in this case is this monthly fair value gap. And you can see how it's consistently been attracting price to the upside. So it's pretty much obvious that price wants to go into this inefficiency. So right there is the drawn liquidity. Now you figured out that this is the drawn liquidity, the monthly fair value gap. The next thing you do is you now go to intraday perspective, and you're looking for intraday price actions using London session, New York session. Now, before you jump the gun and you start looking for those buys, you need to also see a significant break of structure towards that direction. What do I mean? Example, you want to see a daily break. Now, in this case, the market was trending lower, lower high, lower low, lower high, lower low, lower high, and a lower low. And then right here, it rallied, took liquidity, mitigated this inefficiency, went to the downside, failed to create a new lower low, and then eventually we created this higher high. Now, the reason this here is my break of structure is simply because it's rallied and it closed above this previous weeks. Now, if it doesn't close above this area with the bodies, it's not a break of structure. It's potentially either run on liquidity or just manipulation. In this case, it didn't close with the bodies. You can see the wicks, even though this bearish candle closed above, I don't regard that as a break of structure. I only want to see a bullish candle closure. Now, this is a complex break of structure reason because we now eventually had this candle rally above and close significantly above this previous area, confirming my bullish bias on the short-term perspective. And right here, you can see we had a beautiful retest into what? An inefficiency. So all you're looking for, price coming down here into this inefficiency, you can literally use the lower time frame break of structure. What lower time frame break of structure do you use? To keep it simple, you can just count 3 time frames to the left. So you're gonna have to change your time frames, like set your time frames exactly how I've set it if you just want to do that. But if you don't want to do that, you can just keep it simple. If you're using a daily point of interest, maybe a fair value gap, you have to use 30 minutes break of structure to take your trade. If you're using a 4-hour point of interest, fair value gap, or inefficiency, then you have to use 15 minutes break of structure to take your trade. And if you're using a 1-hour point of interest or fair value gap, then you have to use a 5 minutes break of structure to take your trade. So if you're using a weekly point of interest, maybe a fair value gap, then you have to use a 1-hour break of structure. Now, if you want to keep it simple so you don't forget and cram things, you can literally do 3 time frames, lower time frames to the point of interest. So if the point of interest is monthly, count 3 time frames to the left, 1, 2, 3. That means 4-hour break of structure, you take the trade. If the point of interest is weekly, just count 3 time frames to the left, lower time frame to weekly, which is 1, 2, 3. So 1-hour break, you look for trade. Same thing goes with daily. If your point of interest is on the daily, all you got to do is just count 3 time frames, lower time frames to the daily, which is 1, 2, 3. So 30 minutes break of structure, you take the trade. So in this case, we're working with a daily point of interest, which is a daily fair value gap. So price coming to our point of interest, that daily fair value gap, all we just want to see from that zone is a 30 minutes break of structure, and then we can start looking for buy opportunities. And right here, you can see how we came into that position, mitigated that position. So let's see which one of these lows is the overall low. So right here, this is the overall low. So I'll just move it to the center. So this is the high, this is the low, and then this right here is the break of structure. So the moment you see that break, you can just look for your entries, and your entry will be right here. You can use the high. For some of you, you can use the inefficiency as your entry. Right here could be your entry. I personally prefer using the high because a lot of the times, 70% of the time, price will mitigate the high, and about 50% or more, it will mitigate an inefficiency before that continuation. So now, as much as this is where my stop loss is going to be, I need you all to pay attention to what I'm about to say. As much as this is where you're supposed to use your stop loss, because of your broker can actually manipulate price, I would highly recommend you add a few extra pips to your stop loss. If your stop loss is supposed to be 14.8 pips, you can see right here 14.8 pips. If it's supposed to be this, add extra pips to it. Personally, depending on the trade, if my stop loss is below 10 pips, I will add 5 pips to it. No questions asked. But if my stop loss is, for example, in this case is 14.8 pips, I can add probably around 3 pips or 4 pips. So in this case, if I add 3 pips, that will put us at around 17 pips. And I'm very comfortable with that, and that will be where I'll keep my stop loss. Reason, your broker can actually manipulate price. If you put your stop loss here, your brokers know that most retail traders, their stop loss is going to be right here. That is the reason why sometimes you'll be in a trade, it will literally just come very close to your stop. It won't even tap the low, and then it will reverse, but your broker will just close that position and liquidate it immediately and take you out. Because they're already anticipating for you to get liquidated so you can wipe. They are looking for every avenue to wipe you out to make sure you don't even make that money. Because if you make that money, that means they gotta pay you. Who wants to pay anybody? So now you can see that's your entry. That would have been your entry. And what do? You look for another inefficiency you can use as your take profit. You can look for maybe a 1-hour inefficiency, or you can look for a 4-hour inefficiency, or you can look for a daily. It's entirely up to you. You can literally spend time, look for area of interest price will be attracted to. Area that will attract price, which is the drawn liquidity, the magnet that will attract price. Example, you can see here, this is an inefficiency. And here, this is another inefficiency. And here, this is also another inefficiency. And these areas can all be your take profit. You can even have take profit 1, take profit 2, take profit 3. It's entirely up to you. When price hits each level, you can scale out profit. You can see if it hit this level, I'll take 10%. If it hit this level, I'll take 40%. If it hit this level, I'll take 70%. Now, if once you've taken 70, 30 or 40 or 10% or 20%, by the time it's already here, you'll probably have maybe 10% floating profit. So whether it reverses or not, you don't care. Whatever happens to the trade, you don't care because you've gotten paid. You've made a lot of money from that position. And right here, your first take profit, this is literally already 1:1.34. So personally, I don't target for 1:1 anything. My lowest risk to reward is 1:2. So personally, this would be the first area I'll start taking profit. Probably maybe 20, 30%. And then here, I'll take probably like 50, 70% off, just in case if price wants to reverse on me. And if you go to daily to see what that area looks like, you can see that area, there's not really much to work with. And you can also use here as another area of take profit so that if price should for any reason get up to this position, you even make way more money. But don't hold full volume and be greedy and be waiting for price to keep climbing and climbing until they get to this position. Because why? Some of these pairs, some of you don't even know that some of these pairs has averages that they do in a day and they do in a week and they do in a month. Has any of you ever spent time calculating the average price range? A lot of these pairs do. Most traders don't do this. They're only interested in unrealistic expectations. You want to trade to do a 1:10. Have you ever spent time figuring out what a 1:10 percentage will look like on that pair you're trading? After you figure that out, the next thing you ask yourself is how often has that specific pair gone to that level? You will see that a lot of the times those levels are unrealistic. For example, if you're trading USD card, on average, USD card does like 0.7% on average on a very good day, on a very like volatile day, it does 0.7, 0.8. 1% on a very volatile, on a very good week, it can do 1%. So that means if your take profit is above 2%, that means you plan on holding that trade for like weeks on USD card. So these are things you have to put into perspective. You have to spend time. Any pair you decide to trade, spend time and study that pair and see what are the daily averages, the 4-hour averages, the weekly averages, the monthly averages. Like if you look at this is USD card. You can look at this now. You can see that the biggest candles we have is this. How many percent is this? This is just 4%. And this is a whole month. For a whole month, the biggest candle is doing 4%. That is not a lot. That is already telling you that whenever you're on a trade on this, and it's an intraday trade or intra-week, you're trading within the week or swing trading within the week, your expectation should be very realistic. And so you don't hold that trade and you're wondering why the trade hasn't hit your take profit. So going back to the topic for today, this is how you use those inefficiencies, use them as your point, as your take profit, and then you can let price do its thing. And you can see in this case, it smashed through that take profit. And look at what happened at every single one of those inefficiencies that I outlined. Look at what happened to every single one of them. There was always a retracement. Every single one of them. A retracement, a retracement, a retracement. This one here, a retracement. Every single one of them. That is why you need to mark out these zones so that when price hit this zone, you need to pay yourself. Because the only reason this trade worked is because you're trading with this continuation of the counter trend. That's the only reason it worked. If you were wrong with the direction that is going, if you are wrong with your drawn liquidity, you would have gotten stopped out. The trade would have reversed on you. And if you didn't pay yourself with all these inefficiencies, you would have run your stop and you go from making money to making no money and taking a loss. Is it making sense, everyone?
Yeah. What also I've realized is you see the support that the inefficiency that was used as support to the upside, the one you just do, the first one. So yeah, the first one, yeah, this one. So it acted like support and price was bouncing up and down from there.
You will
So
notice that every single inefficiency that failed for sales ended up being used as support for buys.
yeah.
This one failed. It had a slight retracement. We ran lead above it. Look what price did. It came back and used that support. Let me take this out so it's not blocking my view. It came back and
Like
used support.
it's like staircase up and
Yeah.
down.
Then it rallied above this other one here. We had a slight retracement from there. Price rallied above it. I came back and used that support again. And this one right here, we rallied above it. We came back here, we used it as a mini support. We dropped down, rallied above it again, and then dropped down, and then we rallied above it. Now look at this one here that we used as take profit. Look at what happened to that position. It came there, retracement, rallied, and came here and used that as support. Look at it right here. Came here and used that as support and rallied again.
Yeah.
So
it is right to say it is better to catch it with the first support rather, because for me I've been getting like my stop loss has been hit when I take trades within there, like even if you're going up, if I take the trades within when it started moving, even if there's a break of structure, I might get stopped out more compared to the person who was in that first zone which was identified.
Yep. So another way you can also use the inefficiency for day trading is simply by using those London sessions and New York sessions. But before you do that, first thing you need to identify is the drawn liquidity. Like always, the drawn liquidity in this case is our monthly inefficiency here that I already outlined. I'll just clean this so you can see that again. This is our drawn liquidity. So what you can do is during the London session and New York sessions, you can basically just be looking for higher time frame points of interest like 4-hour inefficiency, and then you can scale down to 1-hour inefficiency to see if there's any sort of alignment. If there is, awesome. Then you can just wait for your time frame break of structure. You can wait for like 5 minutes break or 15 minutes, depending on how you want to take it. Or you can wait for multiple breaks of structures, which is the same time frame break twice. So example, you can use this session indicator right here. You can use the session indicator so it can guide you so you're not trading outside your trading session. So right here, you can see here, I'll just use this example. This is 4-hour. Right here, you can see here, this is an inefficiency here on the 4-hour time frame. Now you can outline the inefficiency and you can simply just wait within that trading session to see if there's going to be a mitigation and also if there's going to be any sort of break of structure. And before you continue, you can also check if there's any 1-hour inefficiency there to align it so you can have a much lower risk and higher reward. In this case, there's no inefficiency here, so there's only liquidity, previous low. So that means it's ideal to just wait for 15 minutes break of structure instead of using 5 minutes. And right here, you can see we have this high, this low. Now, unfortunately, this high didn't really close really well. We can only see that this is where the candle closed above. So I don't really regard this as a break of structure because it's just a bunch of wicks. I don't regard this as break because it's wicks. I need to see a candle close above this wicks. And then right here is where we saw the first candle closure on this. So for me, if I wanted to take this trade, my interest on taking this trade would be with this position here. Now, if I want to take this trade and I'm seeing that my stop loss on this trade is going to be really big, what I'll do is I'm not going to be in too much of a hurry to jump in. I'll literally wait for price to tap here and I'll wait for it to break another 15-minute structure and then I'll take the trade. So in this case, seems like price didn't eventually tap that area. And that was because of this fair value gap. So bear in mind, this is also something else to bear in mind. Now, if your area of interest where you want to get in, this is my area of interest I want to get in. If I'm seeing that there's an inefficiency here before that area, what I'm going to do is instead of me putting a limit order here, what I'll do is I'll literally just mark out this inefficiency here entirely because price can always use the inefficiency as support. I'll mark that zone and I'll wait inside that zone for a 15 minutes BOS, the same time frame BOS. I'm not trying to go lower time frame to do anything. I'm waiting for that same time frame BOS. And right here, you can see we created this low, created the high, and then we broke structure. The moment I see this break of structure here, that is me looking for entries. And that is where I will put my entry for my trade. will be right here. And then here will be my entry, and my stop loss will be this low. Now, in this case, you can see my stop loss would have been 9.4 pips. Now, remember, if my stop loss is below 10 pips, I'm adding an extra 5 pips to it. The reason is just because of the slippage or spread or whatever, so my broker doesn't liquidate me. Because if you're on a trade and your stop loss is below 10 pips, you'll notice that the moment you get activated, if you go to your MT4, MT5, you'll notice that your stop loss will be blinking red, showing you that the trade, that price is very close to your stop and it can easily liquidate you. So I don't like seeing that on my trade. So I don't know if any of you have noticed that, but if you haven't, just try to pay attention to that if you're using smaller stop losses. And right here, this would have been the trade. You would have taken the trade, get it, get in, get out, take what the market has given you. And let me show you another example of how you can use this on the lower time frame. So I'll show you with this example, the most recent trade I took and how I got in multiple entries. So right here, the first thing I did, I derived my drawn liquidity, which is my fair value gap on the monthly. The next thing I did was to outline. I outlined the higher highs and the higher lows, the structure. I outlined my market structure. You can see the market structure on the 4-hour is bullish on the intraday. Then after outlining that, the next thing I did was to use my Fibonacci. I'll just remove everything for 1 minute. The next thing I did after I outlined that this is my higher low, this is my higher high, I used my Fibonacci from the higher low to the higher high to derive my discount, extreme discount, and extreme premium. So I can know which area is going to be the best area to buy. Now that I've done that, I can see that before the extreme discount, we do have an inefficiency here. I outlined that inefficiency on the 4-hour. Now, all I'm waiting is for price to come into that inefficiency, and then I'll look for a shift in market structure. Now, I went to 1 hour to align that 4-hour inefficiency with the 1 hour, and I can see clearly that that same inefficiency on the 4-hour aligns perfectly with a 1-hour inefficiency. So instead of me now waiting for a 15 minutes break of structure when price mitigates this position, I'll wait for 5 minutes. And you can see price came into that position right here. We came into that position. And after we came into that position, we broke 5-minute structure. And after we broke this 5-minute structure, my entry was right here. I literally just used the high, used the low as stop loss. Stop loss is 19 pips, so I just added a few extra pips below. And that was the entry. And I was literally just targeting a 1:2. And the 1:2 is right here. And after I got in on this trade, my first entry, the market came into that position, tapped into the position, played around in the entry, and then I was waiting to see another same time frame break of structure, and then it came there again during London session. And let me turn on the session so you can see what I mean. And during London session, I saw a break of structure on this 5 minutes, and that gave me a go ahead to look for entries. And if this didn't happen during London session, I wouldn't have taken the trade. I would have just left just this one entry. But because this break of structure happened during London session, now I'm looking for second position to get in. And right here is the second position. Use the high, and then my stop loss, the low. And this is 11 pips, added a few extra pips below. And then I'm targeting the same thing, 1:2. Now, this one, I knew it was going to rally. Sometimes what I do is I use the same take profit for both trades. But it just depends on how I'm feeling about the trade. If it's a continuation trend trade, let's say if we're bullish and I'm buying for a continuation, long-term bullish, yes, I'll use the same take profit for both entries. But if it's a counter trend trade, I try not to do that because a counter trend trade, you just want to be in and out. You don't want to sleep on that trade because anything can happen and it can reverse on you and run your stop. And now you went from making profit to taking a loss. So you just need to know how to treat different trades. Like I say this for people that are in my VIP coaching mentorship. You don't treat every trade the same way. That is why a lot of traders, they are really good traders, Their strategy works. The only challenge they're facing is they are treating every single trade the same exact way, using the same exact risk, the same exact entries, the same exact take profits and everything. And that is the reason why they're not seeing the long-term result they want to see. Every trade is not going to be the same. A continuation trade should not be treated the same way you're treating a counter trend trade. A trade from a higher time frame point of interest, maybe a monthly, weekly, daily, or 4 hour, should not be treated the same way a trade from a lower time frame, maybe a 1 hour inefficiency, 15 minutes, 30 minutes. You shouldn't be treating them the same way. The reason is because if you're taking a trade from, example, a monthly inefficiency, that trade will have massive momentum to rally. You can hold it more than 1:2. If it's a weekly inefficiency, you can hold it more than 1:3, 1:4, depending on your entry time frame. But if you're taking a trade and you're taking it from a 1 hour inefficiency, you shouldn't be holding that trade more than a 1:2. The moment it hits a 1:2, you need to be out. Because if you don't get out, most likely the market could reverse on you and run your stop. Now you're going from making profit to taking a loss. And you shouldn't be using the same risk parameters for a trade you're taking on the 1 hour time frame and you're taking using the same exact risk. Some traders do this. They go into a trade using 1 hour inefficiency, breakout structure on 5 minutes, and they're risking 1%. Why would you do that? And then you wonder why you keep blowing your account. The reason is simple, is because you're doing things that are literally gonna keep obliterating your account. So depending on the time frame, if I see a daily break of structure or even a 4 hour break of structure, I have the confidence to take the trade with 1%. But if I'm taking a trade and it's literally just a 5 minutes break of structure and it's a counter trend trade, there's no way I'm using 1%. There's no way I'm even using 0.5%. My risk is literally going to be between 0.2% or 0.3% if it's a counter trend trade. For example, this trade was a counter trend trade. There's no way I'm risking 1% on this trade. Yeah, it looks great, high probability, but I'm not risking 1% on this because it's counter trend. And anything can happen, even with the US shutdown. What do you think could happen? The market could literally, we could have a new news could come out on Monday or whatever, and they say, oh yeah, there's no longer a shutdown, everything is fine now. The debts, this has happened, we've printed money, we've done this, we've done that, everything is all good in America. That could literally happen, and this market could spike up. And it could also go the opposite way, and this market could literally dump hard. And then if you're risking 1%, it will literally you will literally lose more than 1% because your broker is looking for reasons to liquidate your position and you just give them one. Look at this price action. This was Trump's tariff plan. Look at what happened. This price action, can you notice that it's rare to see this kind of candle on USD card? How many times have we seen this kind of candle? Just one. There's no other size of that candle here, at least within this 2025. Throughout 2025, there was no other day that this height of candle was printed. The whole of 2025, we're literally on the 10th month. And not even one other month or one other day did the market print a 2.73% in one day. Just once. It only happened once. Can you see? If you can see any candle this size, let me know. If you can see, let me know. I'll be happy to have a look at it. There's none. That is to show you that those high impact news, they could literally destroy your account. Most especially if you're trading against the trend, it will obliterate your account. So try and make sure that when you're trading against the trend, reduce your risk as much as possible. Protect your accounts. Because the moment you blow your account, it's a wrap, it's game over. It's game over. There's no survival anymore. Someone that literally held a 1%, like their account is down 99%, they have a better chance to bring it back to break even than you that has blown your account. Because the moment you blow your account, it's done. Zero. There's nothing else to do from there. Absolutely nothing else. So always try to survive. That's all I can say to you all today. Try to survive. If you don't know what you're doing, seek help. Don't keep quiet and think that help is going to fall from the sky. No help is coming if you don't seek help. There are so many free resources you can use. I do have a free course. If you can't join the VIP mentorship, go get the free course. Watch the videos. It's free. I'm not charging you any money. Go watch the videos. You can go on YouTube. Anybody that you're looking up to, you can watch their videos. It will help you. But if you just keep blowing your account, doing the same thing every single year, hoping to see new results, sorry, it's not coming. There's not going to be any new result if you keep doing the same thing. So that's pretty much it from me today, guys. If you do have any questions, now will be the best time to ask your questions. But if not, then it's a wrap. Does anyone have any questions? No questions. Awesome. So I appreciate you all for tuning in today. Appreciate you all. I think someone has a question.
Yeah.
Isrik, you said you're a bit confused. What are you confused about?
So I'm a bit confused about the market structure because when I move to the higher, let me just say 12 months time frame, like it's very bullish. Then when I start scaling down to a lower time frame, it's showing me that it's in a downtrend. So I don't know how to put it together so I can get the perfect direction. Because sometimes when I do a counter trend on a bigger time frame, I usually get stopped out immediately. So I don't know, or maybe I should watch the recordings to understand more about it.
Yeah. So if you watch the recording, it's gonna help you. If you watch the course, it's gonna help you. They are both gonna help you. But to be completely honest with every one of you, trading is so hard that you could literally watch the course and you'll still have some slight things that you'll be struggling with. And I'm not saying this about my course, any course. You can watch any course at all. Go through it over and over again. There's always going to be those minor things that you will need help with. You will need someone to hold your hand to walk you through those processes. Now, to answer your question here, 12 months is bullish. But if you go to monthly, it is in a downtrend, right? Now, let me ask you a question. Now, if the market is going to come down into this inefficiency to continue to the upside, how is it going to come down in there without being in a downtrend? Is there any way you think the market will come down in there without being in a downtrend on the lower time frame?
No, sir.
So that answers your question. So the market will be in a downtrend in the short-term perspective to hit that level. What you are looking for is a daily break of structure. When you see a daily break of structure, that is the market giving you a telltale sign that at least, even if it's not in the long-term perspective, whether it's in a counter trend, pro trend, the market is already giving you a telltale sign that the trend has shifted momentarily, and you should focus on that new trend shift. Look for higher time frame fair value gap or inefficiency that you will use as your draw on liquidity that will attract price to the next direction. Example, right here, you can see how we literally have been going to the downside, trending to the downside, all the way from the monthly, going to the downside until we came down in here. The moment we came down into this fair value gap, look what happened right here. We broke structure on the daily. This is daily. We're literally trending to the downside. Lower high, failed to create a lower low, created a lower high, lower low, lower high, lower low, lower high, lower low. And this is the trend shift. The moment you see this trend shift, your focus should now be on buys. Which area will I buy? Look for an inefficiency here. Boom, buy. Which area will I buy? Look for an inefficiency here. Boom, buy. Which area will I buy? Look for an inefficiency here. Boom, went up, dropped, took liquidity, rallied. Which area would I buy? Fair value gap. Look at this. Boom. Came down. Played around. Rallied. Came down again. Inefficiency. Right here. Boom. Rallied. came down, inefficiency here, boom, rallied. Came down here, took all this liquidity out. And after that, what happened? It broke another daily structure. This is the high, this is the low. If you were skeptical whether it was going to keep going up, look at that. The market give you another answer. This is the major break. This is not a break. This is run on liquidity. This is the break. Candle closed. Coming back, look for buys. Boom. Coming back, inefficiency, look for buys. Boom. Coming back, look for inefficiency. Buy. Boom. Buy. Is it making sense?
Yeah.
Israel, is it
Yes,
making
sir. Yes, sir. Thank you.
Yeah. So I know a lot of the times when I explain this, most people are like, yeah, you make it sound easy. And then they want to do it on their own. So just ask for support. I created that free group for you all to ask questions. Just ask questions. Sometimes I tell you guys, what are you struggling with? Drop your questions in there. I'm struggling with this. I'm struggling with that. If you don't speak, I'm just gonna assume you all are professional traders and you're making millions of dollars. So that's all I'm
It's
gonna.
it's a continuous journey, if I would say, because I've been there, so I go on and on asking the little questions and getting better at it. So it's a process. It's not like you just look at the video and you're like, now I'm good. So
Yeah.
yeah.
So Rizzo, you're saying sometimes I should post like the trades I'm gonna take and my thoughts as well. I used to do that literally every single almost every day. I used to do it every week. I would do live sessions every week. I would do